Welcome back. Why will anyone want to purchase some of our stock? Well, they will hope to buy low and sell high, of course. In addition to making a profit on their investment, a stock purchaser hopes to earn dividends while they own shares of stock. It will be a nice periodic source of income for the shareholder. Let's learn a little more about how a corporation handles dividends. Cash dividends are declared by the board of directors. There is no legal obligation to declare a cash dividend, but once declared, there is a legal obligation to pay the dividend. Most corporations that pay cash dividends pay them quarterly. To pay a cash dividend, a corporation must have two things. One, sufficient retained earnings to absorb the dividend without going negative, and two, enough cash to pay the dividend. A corporation with a debit balance and retained earnings is said to have a deficit. The deficit is shown as a deduction from equity on the balance sheet. This situation occurs when a company incurs more losses or pays more dividends than total earnings from current and prior years. Most states prohibit a company with a deficit from paying cash dividends in order to protect creditors. This prevents distribution of assets to stockholders during times of financial difficulty. Now, stockholders receive a return on their investment in two ways, as just mentioned. One is through increases in the market value of the stock, and the other is through cash dividends. There are three important dates to remember when discussing dividends. The date of declaration is the date that the directors declare the dividend. At this time, a liability is created and must be recorded. The date of record is important because you must own the stock on this date to receive the dividend. However, no entry is required in the accounting records. And finally, the date of payment is the date the corporation pays the dividends to the stockholders who own the stock on the record date. This reduces both cash and the liability. Let's look at an example. To illustrate, the entry to record a January 9 declaration of a $1 per share cash dividend by the directors of ZTech Inc. with 5,000 outstanding shares is shown in this slide in the amount of $5,000. Retained earnings is debited for $5,000 and common dividend payable is credited for the same amount. It is a current liability. The date of record for the ZTech dividend is January 22nd. Now, no formal journal entry is needed on the date of record. The February 1st date of payment requires an entry to record both the settlement of the liability and the reduction in the cash balance as shown, clearing the liability account and crediting cash for $5,000. Sometimes corporations will distribute additional shares of stock as a dividend without receiving any payment in return. Reasons for doing this include keeping the market price of the stock affordable by increasing the number of shares outstanding. Another reason for a stock dividend is to provide evidence of management's confidence that the company is doing well and will continue to do well. In addition to those reasons, stock dividends make investors happy and the company can hold on to its cash. Apple has recently paid its shareholders both cash and stock dividends, much to their excitement. Stock dividends and cash dividends are different. A stock dividend does not reduce assets and equity, but instead transfers a portion of equity from retained earnings to contributed capital. As previously mentioned, a stock dividend affects just the equity accounts by transferring part of retained earnings to contributed capital accounts. This is sometimes described as capitalizing retained earnings. Accounting for a stock dividend depends on whether it is a small or a large stock dividend. A small stock dividend is a distribution of 25% or less of the outstanding shares. It is recorded by debiting retained earnings for an amount equal to the market value of the shares to be distributed. On the other hand, a large stock dividend is a distribution of more than 25% of outstanding shares. A large stock dividend is recorded by debiting retained earnings for the minimum amount required by state law governing the corporation. Most states require capitalizing retained earnings equal to the par or the stated value of the stock. Remember these two things about stock dividends. Total stockholders' equity doesn't change because no assets are being paid out of the company, and par value per share does not change. Assume for a moment that Quest directors declare a 10% stock dividend on December 31st. This stock dividend of 1,000 shares, computed as 10% of its 10,000 outstanding shares, is to be distributed on January 20 to the stockholders of record on January 15. Since the market price of Quest stock on December 31st is $15 per share, the small stock dividend declaration is recorded with a debit to retained earnings for the entire market value of the shares to be distributed. The $10,000 credit in the declaration entry equals the total par value of the shares to be distributed and is recorded in common stock dividend distributable, a temporary equity account. Its balance exists only until the shares are issued. The $5,000 credit equals the amount by which the market value exceeds the par value. This amount increases the paid-in capital in excess of par value account in anticipation of the issuance of shares. No entry is made on the date of record for a stock dividend. On January 20, the date of payment, Quest distributes the new shares to the stockholders and records a debit to the common stock dividend distributable account, zeroing it out and crediting the common stock account for the par value of the stock distributed. As I've mentioned previously, stock dividends result in changes within the stockholder equity section of the balance sheet. In general, it changes in three ways when a stock dividend is declared. First, the amount of equity attributed to common stock increases. For Quest, from $100,000 to $110,000 for 1,000 additional declared shares. Second, paid-in capital in excess of par increases by the excess of market value over par value for the declared shares. And third, retained earnings decreases, reflecting the transfer of amounts to both common stock and paid-in capital in excess of par. The impact on stockholders' equity of Quest is shown above when its 10% stock dividend is declared on December 31st. A large stock dividend, that greater than 25% of outstanding shares, is easier to record. State law generally requires that a corporation capitalizes retained earnings equal to the par or stated value of the newly issued shares. To illustrate, suppose Quest's board declares a stock dividend of 30% instead of 10% on December 31st. Since this dividend is more than 25%, it is treated as a large stock dividend. Thus, the par value of the 3,000, computed as 10% outstanding shares times 30%, dividend shares is capitalized at the date of declaration with the entry shown. This transaction decreases retained earnings and increases contributed capital by $30,000. On the date of payment, the company debits common stock dividend distributable and credits common stock for $30,000. The effects from a large stock dividend on balance sheet accounts are similar to those for a small stock dividend, except for the absence of any effect on paid-in capital in excess of par. Rather than paying a stock dividend, a corporation might decide to split its stock. A stock split is a distribution of additional shares to stockholders according to their percentage ownership. When a stock split occurs, the corporation calls in its outstanding shares and issues more than one new share in exchange for each old share. Splits can be done in any ratio, including a 2-for-1, a 3-for-1, or higher. When a stock split occurs, the corporation calls in the outstanding shares and issues new shares of stock. In the process of a stock split, the par value of the stock also changes. To illustrate, assume Thomas Inc. had 100,000 outstanding shares of $20 par value 20 common stock. A 2-for-1 stock split cuts the par value in half as it replaces 100,000 shares of $20 par value stock with 200 shares of $10 par value stock. Let's see the impact on the balance sheet. The split does not affect any equity amounts reported on the balance sheet or any individual percentage ownership. Common stock still has a balance of $2 million. Both the paid-in capital and retained earnings accounts are also unchanged by a split, and no journal entry is made. The only effect on the accounts is a change in the stock account description. Thomas Inc.'s 2-for-1 split on its $20 par value stock means that after the split, it changes its stock account title to common stock $10 par value. This stock's description on the balance sheet also changes to reflect the additional authorized issued and outstanding shares in the new par value. In many respects, a 100% stock dividend and a 2-for-1 stock split result in similar impacts in the stock market. The stock split usually requires more administrative tests to call in and reissue stock certificates. However, sometimes corporations do not issue certificates in a stock split, saving some of the administrative costs. This completes the dividend section.